Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman. He's the derivatives portfolio manager at PI Financial in Vancouver. His websites, pifinancial.com and polarfuturesgroup.com. Welcome back to the show, Drew.
Thanks for having me on today, Jim.
Drew, all the market talk seems to be centered around the coronavirus. What impact are you seeing this have?
Yeah, I think the way that I look at markets, and again, it's going to be more of a macro top-down look at markets rather than specific companies, but it does really seem to be the risk impact. That's the sort of fear that people have, that they don't know how bad this thing could be. I mean, I don't know how bad this can be. I've read some of it, but I'm by no means an expert on, where it can get to. You see a lot smarter people that have projected models on how many people are going to be sick, and I think that's what the market is just trying to digest. And, we had some severe market reactions on Friday afternoon with the S&P. So I would say the S&P tends to be a very good barometer of a fear gauge. I mean, everybody talks about the volatility index being a fear gauge, but overall, if people are going to be worried, you'd see selling in the S&P 500, the big U.S. stock exchange, stock market. So I think the fact that we saw that sell off as much as it did on Friday, it opened lower, and then really held those levels throughout Monday, and now we've moved back higher the last couple of days. It may be a bit of, okay, maybe we overreacted, which the market tends to do. It tends to get that herd behavior when there's a little bit of fear going. So selling begets more selling. And we've had a stabilization now, but again, it's going to be a developing story that will continue to impact markets. So I think it's going to be key to watch how it develops, and again, not try and have a bias to say this stock market is now oversold or it's bounced enough, because it's going to just be sort of continuing headlines that will continue to make stories. So the latest, of course, all the flight cancellations from different airlines that are no longer going to be servicing flights to China, and that's one, I think, in part to maybe help the spread slow down, and two, because people don't want to get on those flights anyway, so they're not going to make money flying those airplanes. So that's been a negative again coming in. We can see it in a big way in a lot of the commodity markets that I look at as well. I mean, we look at crude oil is now trading at $53. I mean, it was only a month ago on the Iran situation that crude oil was up at $65. So that's a $12 drop that we've seen in crude oil. And a lot of that has been in the past week or so, as we've had more worries about the coronavirus. Again, it's going towards the impact of travel. How much travel will be impacted by the lack of flights that are going on. Of course, it's the New Year's holiday in China, so if people were expected to be flying a lot and they're not, what does that demand impact have? Now, again, jet fuel is a important part of the fuel demand in China, but not the only part. And again, as part of the global environment, China's important and their jet fuel is important, but maybe not as much as is being priced into the oil market. And again, with oil specifically, I would go and say the product in the last week that's come offline in Libya is more than likely going to offset what was taken away from the coronavirus scare. So there are some maybe overreactions that are happening in price. But again, I think it's the open-ended risk that people don't necessarily want to get in front of. And the other market I just have to point out is the copper market. The copper market has just cratered. It's been down 10 days in a row, and of course everybody looks to copper as Dr. Copper to see how the global economy is doing, and it, I think, has that extra edge of how is the industrial machine within China going to be doing. So that's obviously a negative signal that people are taking. We were much higher in copper prices. It was only, again, like I say, 10 days ago, we were near $2.90. We're down at $2.56 right now. So that's an extreme sell-off. So again, I think it's people not knowing how long or how bad this can be, and therefore, getting aggressive with some risk mitigation. But at the same time, I'm seeing, the equity markets sort of trying to sort of deal with it and deal with it, near record highs. And maybe part of that is earnings in the U.S. are coming out right now. Apple yesterday hitting new record highs. So you've got some of the leaders of that market helping to stabilize things. But then you've got Starbucks, which also had good earnings yesterday, trading lower because they're going to be closing over half their stores in China for a period of time that we may not know how long that's going to be, and they could be closing more stores. So again, just more worries on the fact that this seems to be more open-ended than something a little bit more specific. So I think these worries can persist, and my one note on this would be to say, don't step in with a strong bias and try and prove that your view is right, because these markets, when they move on these sort of events, can just go further and faster than you really think they should.
We'll have more with Drew Zimmerman right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, given the severe moves in those commodity prices, do you think they're overdone?
Yeah, just as I was touching on before the break, I think it's hard to say when something is overdone and when it's not. And when you do get these fear moves, they can tend to feed on itself, and those bigger price swings will bring other sellers to the market. So it's never an advisable strategy to try and catch the falling piano is the axiom there. However, a few of the markets that I think are reaching levels of extremes, with copper prices, for example, being down at $2.56. Rarely in the last 3 years, I'm talking about a few days, have copper prices been below $2.50. That's not to say they can't go below $2.50 if China was expected to be on sort of shutdown mode for a much longer period of time. But you're starting to see a market that's now down 10 days in a row and had some very sharp selling on a few of those days. So some of them are reaching sort of oversold levels. And as I mentioned before the break as well, with crude oil coming from less than a month ago up at $65, down at $53. And you've also got some other geopolitical issues that are going on. As I mentioned, the output of Libya really slowing dramatically and could be down to almost nothing, which easily takes 800, maybe 1 million barrels a day off the market, which would more than offset, again, what we're seeing so far anyways in the jet fuel slowdown demand. So again, it might be an overreaction in a few of these markets that is worth taking a look at and taking advantage of. The other thing that I like to see and focus on is as we see these sharp moves, you see implied volatility pick up that makes the options market, if you've got a bias to step in, a good tool to use. If you've got the ability to sell those options, you're getting paid for something that's very rich. It's I always sort of equate the option market to insurance, like fire insurance on your house. So, the house is partway on fire and you're trying to buy insurance on it. That insurance is going to be incredibly expensive. So, as an insurance provider, if I think, you can control the situation, it's a great way to take in a lot of premium by selling some of those options. So that's a good strategy when you're seeing these kind of moves. But again, small size, piecing it in, because these moves can go a lot further than you think they should. So on the other side of this is the gold market. I mean, gold had a jump up. We saw gold prices doing much better as, again, people become fearful. To me, though, gold has been a little weaker than some of the other assets. So I was using Friday's close in equities, Friday's close in oil, Friday's close in bonds as sort of a key benchmark. And gold was one of the few assets that finished below its Friday close. So after it had rallied up on Monday and Tuesday, it was below those levels. Where equities were just starting to get back to those levels, bonds still well above those levels. So to me, there's a little extra weakness in gold that tells me maybe if this coronavirus continues to be more of a story, gold might not be as big of a hedge against that as people initially thought it was. I mean, it still is deemed a safe haven asset, but again, if we're seeing a slowdown on a coronavirus fears and what that will do for manufacturing and commodities, that tends to be more of a deflationary event, which kind of works against gold, where gold is more of an inflation hedge. So I think some of the commodities are overdone and maybe worth sticking a toe in the water, but again, I would advise on small size and be very tepid and be ready to be wrong quickly, because some of these moves can really go just a lot further and so much faster than you think they could and or should.
We'll have more with Drew Zimmerman right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. The U.S. Fed met today, Drew, and held rates steady, but what's your long-term outlook on interest rates in the U.S.?
Yeah, another Fed meeting today, and after they were cutting rates through the middle of or end of last year, another hold steady, which was as expected. I think the interest rate statement had a one-word change in it, which again shows that they really didn't change their view. We have seen, it's been very interesting that even as equities have continue to move higher in a pretty steady fashion from the beginning of October last year, ever since the turn of this year, we've seen interest rates really start to weaken again. So we had the U.S. 10-year close to about 2%. We were 1.95% or so, and we're all the way down to 1.6% on the Fed meeting here today. So even though equity markets have continued to grow and move to higher prices, the bond market seems to be sensing that maybe not all is well. That can be a take of it. One of the old sayings in the market is, equity is the sort of fast money, but the bonds are the smart money. So maybe they're smelling something that is happening with the global economy. Maybe they're thinking equities are getting a little ahead of themselves. I mean, it's been an incredible rally, not only all of last year, but especially in the last 4 months that we've seen. And then especially with this added worry of the coronavirus. However, I think as we see these economies continue to, muddle through, might be the best way to do it. I mean, some of the manufacturing data that we've seen globally, I would say in the last year and a half, we've definitely had a manufacturing recession in much of the world. Germany, especially German GDP last year, 0.6%, not a lot of growth there. But we've seen in the last few months sort of a bottoming of that. So if that sort of bottoms and holds in, and the U.S. economy can continue to do well, I mean, we're going into another election year where more might get promised as we go into the election. Trump already talking about more tax cuts for the middle class, already talking about phase 2, now that we've got phase 1 of a trade deal done with China. Will that be something that is a little smoother than the last process, and especially in light of the fact that, an agreement might help the world economy come back from an influenza outbreak, depending on how bad that gets. So I get the feeling for me, given what I'm watching, that I think we are nearing another low in interest rates. We had all-time lows in the U.S. long bond just September 3rd of last year, so not that long ago, and it has been, a 30-year trend where interest rates have been moving lower. So it's hard to fight that. But I think with central banks, willing to stay at around this area, and the central banks in Europe maybe realizing that they don't want to go more negative, that this negative interest rate policy really hasn't done a lot to boost things. If we see that shift go from central bank policy to more fiscal policy, where governments are starting to do more, then I think we've got, rates that can start to move higher. And if you've got more fiscal policy, again, you can talk about the deficits in the U.S. until you're blue in the face. They don't seem to matter as much, but I think it will come to a point where investors that are buying these bonds want to get some sort of return. Otherwise, as more and more people retire, they just have to stay in riskier assets. So I do think that the global economy seems to be doing okay. I think this is a push on fears over a coronavirus that is spreading very quickly, which is a rational thing to do. You want to go into safer assets like U.S. Treasuries. So I don't want to say that in the short term that we've seen the lows in interest rates, but I would look for interest rates to sort of hold the recent lows that we saw last fall. And then I think from there, there's much more move to the upside over the medium term in interest rates than there is a further move to the downside.
How does your outlook on interest rates impact the Canadian dollar?
Yeah, that's a very good question. As I said, I think the Fed is on hold for quite some time, but we just had the Bank of Canada last week come out and really give us pretty straight hints that the Bank of Canada could be looking to cut interest rates. And the fact is, at the end of last year, they were even thinking about an insurance rate cut. But they've told us this time that if they do cut rates, it won't be an insurance rate cut. It will be because the Canadian economy needs it. So with regard to interest rates, when there's a differential or a differentiating policy between the central banks, that's going to weaken the currency. So I think the sentiment towards the fact that the Canadian economy's still been sluggish. People are still quite in debt here in Canada. And I know the Bank of Canada is aware of that. And I think maybe some of their trepidation on cutting rates is the fact that they don't want to be accused of blowing a further real estate bubble, especially in the Vancouver and Toronto markets. But at the same time, I think the rest of the country, and it's hard because you have quite different sort of economic pockets throughout Canada, but you only get to set one rate, and you've got to set it for the whole country. So I think they really need to pay attention to some of the weakness that we're seeing in other parts of the country. I think the market is sensing that they're, on the verge of having to cut rates, and if they do that, that will weaken the Canadian dollar further. So I see some more economic underperformance in Canada, again, with crude oil as low as it is, and we've got the Western Canada Select, that's the benchmark for crude coming out of the west of Canada, is at a $24 discount. So right now that's, under $30 for a barrel of crude that we're exporting. And again, when you look from an international perspective at Canada hasn't been able to expand capacity on energy getting out of the country. So some worried about further growth in that sector from an international side could add more pressure to the Canadian dollar as well. So when the U.S. dollar weakened into the end of the year and Canada got over 77 cents, I think that was more of a weakening U.S. dollar into the end of the year story. And as we've seen the U.S. dollar strengthen through the first month of this year, the Canadian dollars dropped on that, and I think we could continue to see this move lower until it finds a bit of support at 75 cents. And if the Bank of Canada does have to cut rates on weaker economic data in the coming months, then I think we drop below that 75 cent level. And again, the Canadian dollar was incredibly stoic against the U.S. dollar all of last year. We largely traded within a 3-cent range. So maybe we'll see a little bit more volatility come back to the currency markets. And again, that could kind of catch people off guard if it's been, 12 months, 16 months, 18 months since we've seen that kind of volatility.
Drew, thank you so much for chatting with us.
Thanks for having me on. I feel like I got a little long-winded today, but I hope it was useful.
My guest has been Drew Zimmerman. He's the derivatives portfolio manager at PI Financial in Vancouver. His websites pifinancial.com and polarfuturesgroup.com. If you have any questions for Drew or any of our guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.